Welcome back to the charting episode. As we know, it is difficult to look at the 20 closing prices in the table and get an idea of whether the stock price trend is up, down or sideways. Now look at the figure 3.1 shown here. This chart contains the same information as table 3.1. Notice how much easier it is to process the information for our brain. As the old saying goes, a picture is worth 1,000 words. With just a glance at the chart, you have a roadmap of where prices have been in a fraction of a second, and you can easily spot the highest prices and lowest prices that occurred during the period. A chart quickly transforms a table of data into a clear visualization or a visual representation of the information. Next, we would like to discuss about what data is needed to construct a chart. To construct reliable charts, the technical analyst must be sure of the trustworthiness of the data. We currently use data from the data stored by our own firm. We use Power BI to present that data and not other things. We mostly use the FTMO MP4 charting server to get our current data feed for new members, as they have the lowest spread possible, and they are also our one of the funding partners. We currently have 19 funding partners, so be ready to get funded if you are selected. So when a price error occurs at a high or a low for the trading day, the error is especially troublesome because it affects daily calculation of averages and oscillators using highs and lows. It is therefore important that any data used for charting is extremely clean, reliable. In addition to trading errors, other data errors can occur through stock splits, dividends offerings and distributions. But in the commodities market, because contracts have a settlement date at which trading halts, incorrect calculation of the time and price linkage between contracts may affect longer term technical patterns and trends. So what are linked contracts? The question might have been arised after hearing my voice. For short term testing and analysis of future contracts, you can use the actual contract data. The test period must be extremely short. However, because the liquid portion of any contract, the period when active trading occurs, is only a portion of the contract time span. Thus, the data available for TLC study is short, and to test a number of signals, it must be separated at the short intervals. Once the trading signal horizon exceeds an hour, however, one must calculate a linked contract to provide sufficient data to testing. There are three basic types of linked contracts: the nearest future, the perpetual, and the continuous. Each has its advantages and disadvantages. The perpetual contract, also known as the constant forward, to avoid the nearest future rollover problem, uses a constant forward price, namely the anticipated price some specific period ahead. The nearest future option, or the nearest future method, is just a plot of each futures contract as it expires and is replaced by a new contract. The third method, the continuous contract, is more realistic but is useless for calculating percentages. Changes over time. It adjusts for the premium difference between the current contract prices, the price of the previous contract, and the contract into which the trader rolls his position at a specific rollover date. Avoid the trading bias that occurs as the contract near its end. The continuous contract then carries the adjustment into the future. It reflects exactly what would have occurred to a portfolio that invested in the first contract and rolled over each contract at its rollover date. It is thus a realistic expression of the history of the future contract and can be used for testing past data. It has two problems, however. One is that because the adjustments are additive, the continuous contract cannot be used for percentage returns. And two, and the ending price of the continuous contract is not the same as the current price of the current contract. The continuous contract is the primary contract used for testing trading systems. We mostly don't use continuous contracts as they are used by many other, but yeah, we will know in depth in section 3, I guess. So we will wrap up the content of today's lecture in here, and tomorrow we will study what types of charts do analysts use. Thank you.